Hello, ladies and gentlemen. Welcome to today's webinar. I'm Joseph Novichkov, the Senior Trading Manager for GDM. As you can see from your screens right now, today's topic is Elliott Wave theory. The first thing that I wanted to mention about Elliott waves is just a brief presentation of what it means. Later into the session, we will see the basic patterns. Also, we will see the wave modes and the complete cycle as well. Of course, we will have to mention the essential design of the Elliott waves, but the variations of the basic theme and wave degree. In the final stage, of course, we will have to take a look at how to trade the Elliott wave by using Fibonacci retracement. And by mentioning Fibonacci retracement, those levels that we will be using will be the default settings. Why? You will find out later into the session itself. First of all, the wave principle is Ralph Nelson Elliott's discovery that social or crowd behavior trends are reverses in recognizable patterns. Using stock market data for the Dow Jones Industrial Average as his main research tool, Elliott discovered that the ever-changing path of stock market prices reveals a structural design that in turn reflects a basic harmony found in nature. From this discovery, he developed a rational system of market analysis. Elliott waves are a very good system to predict market behavior on daily to weekly charts. It's a very good mid-term technical analysis tool. Under the wave principle, every market decision is both produced by meaningful information and produces meaningful information as well. Each transaction, while at once an effect, enters the fabric of the market, and by communicating transactional data to investors. The feedback loops is governed by man's social nature. And since he has such a nature, the process generates forms. As the forms are repeatedly in time, and they have a predicted value. Elliott isolated 13 waves of patterns of directional movement that, of course, occur in markets and are repetitive in form, but are not necessarily repetitive in time or, as we say, amplitude. So he named, defined and illustrated those patterns. He then, of course, described how these structures link together to form larger version of the same patterns. Now, how those in turn are the building blocks of patterns of the next larger size, and so on. His description constitutes a set of different rules and guidelines for interpreting the market action, basically, to predict the market direction. The patterns that naturally occur under the wave principle, we will take a look at each and single one of them, starting, of course, with the basic pattern. Now, in markets, progress ultimately takes the form of five waves of a specific structure. 3 of these waves, which are, as you can see here, labeled as 1, 3, and 5, actually affect the directional movement. They're separated by 2 counter-trended figures, which are here labeled as 2 and 4. The 2 counteracting trend figures are apparently a requisite of overall directional movement that occurs. At any time, the market may be identified as being somewhere in the basic 5 wave patterns at the largest degree of the trend. Because the 5 wave patterns, ladies and gentlemen, is the overriding form of the market progress, all other patterns are submitted by it. Now, the wave mode, there are actually 2 modes of wave development: impulsive and corrective. Impulsive waves have a 5-wave structure, as we mentioned, while corrective waves have a 3-wave structure or a variation thereof. Impulsive method is employed by both the 5 impulsive, by the 5 pattern that you see here, and it's the same directional components, wave 1, 3, and 5. Their structures are called impulsive because they powerfully impel the market. Okay. The corrective mode is employed by all counter-trend interruptions, which of course include waves 2 and 4, those which you see over here. Of course, their structures, as we mentioned, are called corrective because they can accomplish only a partial retracement or a partial correction of the progress achieved by any preceding impulsive wave, which is 1, 3, and 5. Okay. So let's take a look at the complete cycle on the next picture here that you see. A 5-wave impulse is followed by a 3-wave correction to form a complete cycle of 8 waves. The concept of 5 up followed by 3 waves down is what you can see over here. Now, let's take a better look at the components here of this cycle. Now, of a larger degree, it illustrates same direction components of an impulsive wave, and each full cycle components, waves 1 plus 2 or waves 3 plus 4 of a cycle, is smaller version of itself, is what you can see here. It is structural to understand, ladies and gentlemen, an essential point here. The next will show you that on this screenshot here that we have, not only we illustrate a larger version of the previous one, which is this one, okay, it also illustrates the whole picture. This wave as well. As you can see, this one is more complicated with smaller waves inside of it. The way you see it in a larger scale is like this. If we examine, of course, a little bit closely, we would take the same form as wave 1 bigger here and wave 2 here. Those waves of any degree in any series always subdrive and resubdrive into waves or lesser degree, and simultaneously are components of waves of higher degree. What are we talking about higher degree? That means on a larger scale, on a bigger time frame. This is what you see. It's one and the same. Basically, smaller degrees are inside the bigger degrees. To put it here so we can understand what I'm trying to say. And as we mentioned, this is the essential design of it. Now observe that within the corrective pattern, as we have shown here on wave 2, this one, wave small a, and of course wave C here, which points downward in a downtrend, are composed of waves 1, 2, 3, and 4. Similar to every other over here. So the larger waves are composed by smaller waves, whether they're corrective or not. This construction discloses a crucial point, that impulsive waves do not always point upward, as we mentioned, and corrective waves do not always point downward. It really depends on the trend. The mode of a wave is greatly determined not by its absolute direction, but by its relative direction. Aside from our specific exceptions, which we will be discussing later into the session, waves divided in impulsive mode, 5 waves, when trending in the same direction as the waves of one larger degree of which is a part, and in corrective mode, when trending in the opposite direction, that is. Which means waves A and C here are impulsive, trending in the same direction as wave 2, which is on a larger scale. Now wave B here is, can anybody guess? This points upward and is composed of 3 waves, smaller ones, A, B, and C. This construction discloses, as we mentioned, this crucial part. Now, aside from our specific exceptions, this is something that needs to be taken a look at from a deeper point here. You need to understand what those waves means. That means bigger wave is within it is included smaller waves. So what did we actually learn so far? Impulsive waves can not only be in upwards, they can be downwards. They're moving in the same direction. The opposite ones are corrective. So the corrective themselves, they cannot be actually in downward only. They can be upward as well, as we showed here. Wave B, it's pointing upward. That's a corrective wave. Wave A and C, same direction as the larger scale. Wave 2, those are the impulsive modes. Okay, what are the variations of the basic theme? The wave principle would be simple to apply if the basic theme described a few minutes ago for me were the complete description of the market behavior. However, in the real world, fortunately or unfortunately, is not so simple. Now let's take a look at the wave degree. All waves may be categorized by relative size or degree. Now, Elliott has recognized 9 degrees of waves, from the smallest on an hourly chart to the largest wave. He would assume, of course, exists from the data then available, which is on the monthly chart. Now, the names that he chose are the following: grand supercycle, supercycle, cycle, primarily, intermediate, minor, minute, minuet, and subminuet. Cycle waves subdivided into primary waves that subdivide into intermediate waves that in turn subdivide into minor and subminor waves. It is important, so ladies and gentlemen, to understand that these labels refer to specifically identifiable degrees of waves. So the analyst can identify precisely the position of a wave in the overall progression of the market, much as longitude and latitude are used to identify geographical locations, all right? So let's say that the Dow Jones Industrial Average is in a minute wave, of minor wave, of intermediate wave, to primary wave, 5, of cycle, which of course transforms in a supercycle wave of the current grand supercycle. So this is to identify a specific point along the progression of the market history. Now, when numbering those waves, you need to remember some specifics. I've listed them over here. The wave degree, the 5 cycles with the trend, and 3 cycles against the trend. This is the way that you can put labels on your chart. So every time you start making a technical analysis, let's say, you start from the minor waves and subminor waves that you can see here. Then you are escalating into a bigger picture, larger time frame, to intermediate primary cycles, super cycles. And you can label all the way so you can count those waves and to predict the market. This is just a briefly explanation of what the Elliott Waves basics are. However, the difficult part comes when you have to trade it. So the first thing you have to remember is that any time you see a possible wave degree, you have to label it, whether it's with the trend, whether it's against the trend. Of course, it always first starts with the trend, and then the second is against the trend. But first, you need to identify which wave degree you're looking at. Therefore, you have to choose the smallest time frame into the largest time frame. So you can check all the cycles and subcycles of this current market movement. Let's take a look at the chart, ladies and gentlemen. It's time to see how we can trade those Elliott waves. So let's just find the chart. There we go. Now what you see in front of you, this is the S&P 500 daily chart. Much as we're talking about those types of waves, now we're going to start counting them. As we can see, we have a directional move somewhere here. We still have no idea whether the market will continue to the upside. But what we can do is just start counting those waves. We have an uptrend. Clearly, it finishes somewhere here. And then a corrective wave begins. Finishes over here. So, now we have 2 points. Point number 1 and point number 2. We can expect a continuation to the upside from point number 2 up there to point number 3, whereas 1, 3 are the directional wave. Wave number 2 is the corrective one to the downside. And then you have third one to the upside is your impulsive wave as well. Then you have a wave number 4 here, which is another corrective wave. We're going to name them like this. Impulsive, corrective. Impulsive, corrective. We have a wave number 5 here, which is once again the impulsive wave to the upside. And this is the 5 to 3. Yet again, you can see that the wave starts falling down. The uptrend is over. It changes into a downtrend, from where we have a new wave, let's call it A here, which is an impulsive wave. So what do we know? It's a down wave, but it's an impulsive wave because it's within the trend. How do we know that this is an impulsive one? By having a lower high here, let's call it B, which is the correctional one. Now it's to the upside. So now you can see how an impulsive wave is not really relevant to the direction, which is the same for the correctional one. It doesn't matter if the market is up or down in a trend. The correctional and the impulsive waves are those which move towards the direction of the trend or against it. This is the only and easiest way for you to remember it. And we have a large move to the downside with number C. Which is, of course, the impulsive wave one more time. All right, ladies and gentlemen, now how do we find out wave number 1, 2, 3, 5, and so on? This is number 4 here. It's very easy. As I mentioned in the beginning, we need to use Fibonacci retracement. Now, the thing Fibonacci retracement is used, especially with Elliott waves, is that we have to use the default settings. Why is that? Let's talk a little bit about the S&P 500 that we have chosen. Now, if the Elliott wave theorist or analyst recognizes that the trader just completed the leg form from a cycle number 2 here, as we mentioned, up to cycle number 3, and then the market is beginning to retrace. We can put a buy order somewhere here. How do we find out that this is the buy order? Let's use the Fibonacci retracement. I've already presetted the settings here for the Fibonacci, and we are going to measure the retracement in percentages. So as we've learned so far how to recognize trend direction, whether it's sustained or not, if we're going to count wave in sizes, we need to be absolutely sure what exactly we're counting. So the first thing we count here is the first high, which is our point 1, wave 1, which we already mentioned. We saw a retracement down to 23.6% retracement. Now, those are the default settings here, ladies and gentlemen. That's what you need to witness, and you need to remember. The levels of 66 and 33%, let me make a slight deviation here, which we mentioned not long ago. Those are used for different purposes. You can still measure, as we mentioned, the trend strength. However, in most cases, as we mentioned, those levels are giving you targets. From here, you are just measuring the wave. The wave 1 is completed. The wave 2 is completed with the retracement. Once we see a break of level 0, we can start counting level 3, wave 3 retracement, which is over here. How do we find that out? You will see right away. The next time we measure the wave, it's not going to be an extension of the Fibonacci as we usually do. What we need is a new Fibonacci. Sorry, this is liquidation channel. New Fibonacci from our second wave, and we need to see whether the retracement is within the range of 23.6 or 38.2. However, if we have set a long position around the 23.6% here, sorry, somewhere at this side, that will definitely mean that this will probably hit our stop loss, which is not necessarily a bad thing. Because in Elliott Wave, when we see a correctional move of at least 50% of this wave, that would mean a definite continuation to the upside. Or should you say it's a strong support. As you can see, it's supportive exactly at 50% here on this place where we can set up a new long position with no matter that this here, which we actually predicted that the market will bounce off from here, is hitting our stop loss at a 38.3% retracement in the Fibonacci. Our long position from here will make us enough profit to erase the previous loss and even double in size from what we lost, but in a profit. Now we need to realize that every time we are measuring a wave, we have to see how it moves. Let's check out the next wave. Again, with the Fibonacci, we know that this is the final wave we got here, which is wave number 4, from where we have to extend the Fibonacci to the highest point after the slight retracement here. Let's take a look at the Fibonacci and see what the next possible retracement could be. Now, based on the fact that this slight retracement is with a lot of shadows here, huge dodges, we're definitely sure that the price will hit a new high very soon. That's why we're extending it straight to the very top. And as you can see, the price stays within the Fibonacci retracement range for as long as the trend reverses. When we see a break off with 100% retracement from the final wave 5 and the previous wave 4, from where we extended the Fibonacci, we know that this is the absolute maximum for Elliott waves, okay, 5 to 3. Therefore, we're expecting to fall down. But we only start counting those waves when we fall below the 61.8%. Therefore, the first time we fell below this percentage is over here, which makes it our point A, which is the new directional wave. And its retracement will be measured by the same way we did so far. Take the Fibonacci retracement the opposite way. We extend from wave 5 to wave A to see whether the retracement afterwards is sustained. In this case, we have a false breakout here, which normally occurs in some cases. We cannot avoid it. It's the market. Luckily, what we can expect here is a new wave count. That means this first wave here is still valid. And our new low is down here. Wave C, which of course occurs that this is the correctional wave here. Now, this false breakout above the 61.8% occurs in extreme market conditions. What you need to remember is that when the wave count 5 is over, after some time of a sideways movement, the market will start going down for at least 100% retracement. This is the thing that you have to remember. And on top of that, we have a huge double top formation here. Now, ladies and gentlemen, this is the point here to remember. This is when I mentioned that in real life, it's not so easy and it's not so perfect. So even if the Elliott Wave theory is a good tool to analyze market conditions and predict future behavior, of course, in real life, there are situations like this here, a move above the 61.8% retracement, and a few candlesticks are closing there. People that are not aware of the wave count and they have not counted the market will definitely lose money here if they've already entered the market, let's say somewhere above here on the breaking through this one. They think that the market will automatically go to the downside. Without a correctional wave, it's not possible. This is why we have the impulsive and correctional waves. That's why we need to count them. Now, this particular style of predicting the market is very suitable for long-term investors to predict points of entries, especially on a directional move. It will grant them with the right to find out when the market is up to reverse, so they can exit their positions and wait for a better opportunity to enter the market. As you can see, the chart in front of you is exactly what happens in real life. You have fake breakthroughs, but still the Elliott Wave count is valid, no matter that in some extreme market conditions we have breakthrough from our retracements, from our retracement points, from where we should actually see a bounce off. That's why person should not get scared. The bad part will be when the price breaks through this level here, the 100, which is the higher high in wave 5. That will definitely mean that this is a, should we say, a new wave on a higher, on the higher, on the higher scale. How do we find that out? Well, if we see such a breakthrough, we should definitely measure from the lowest point here to the highest, from where we can see that the retracement is exactly 23.6%. This is why you should be using Fibonacci retracement always. It's valid and it's good for you. It's going to make you profits. For some of you, I can see that this topic might look a little bit boring, but try to understand that this is how the markets work. They work in cycles which are repeated in time. That is why you need to at least learn the basics of Elliott Wave concept. Try to look for them on a larger scale. It's much easier. On the smaller time frames, there are more waves to count. On the smaller scale, it's of course more with higher possibility of invalidation of certain levels of the Fibonacci retracement, especially when you have something bigger on the bigger picture. That's why I chose you the daily chart. It's good for intraday traders. Also, it's very good for weekly traders as well, and investors on daily, weekly, monthly chart as well. Well, that's about it about today's presentation. It's not a difficult thing. The only thing is that I'm going to ask you is if anyone needs to find out one more time about those cycles, the grand super cycle and the smaller, the minor cycles as well, the wave degree and their labeling, I can of course send it over a PDF. You know how to find us through the support department. They will help you find me as well directly. However, or you can just leave a message here in the chat. If you're not an existing partner, not an existing trader at this moment, please send me the email address from to which I can actually send you that information. That's it for today. Thanks everyone for joining. Now there is another thing I need to remind you about the next webinar. The next webinar, this will be this Friday. We will be talking about the whole summary of this month, basically every additional oscillator and indicator that we've been using on the technical chart to recognize uptrend, downtrend, sideways trend, and how to trade it. We will find out which strategy to use at the right moment, at the right time, when the market is ripe enough for you to enter. So don't forget to register for the next webinar. And of course, next week we will hold the question and answering webinar seminar, from where actually you can participate live for everyone to hear your questions, your explanation, whether it's about psychology or anything in technical environment. We can discuss that next week. Thanks a lot for joining. I'll see you again this Friday. It was a pleasure for me. Bye-bye.